In this video, I will discuss error analysis. In the last video, we talked about how to correct an error that has been identified. In this video, we are going to analyze the effect of errors assuming they have not yet been corrected. Primarily, we are going to be concerned with the income statement impact. Did the error increase net income and make the company look more profitable than it was? Or did it decrease net income and actually undersell the company's performance? Either way, errors in the financial statements could cause financial statement users to make different decisions than they otherwise would have had they had the correct information. Error analysis can be tough to bend your mind around, so this video will essentially be one big practice problem. Let's get started. For this example, we are going to indicate the effect of any errors on the net income figure reported on the income statement for the year ended December 31st, 2016, and the retained earnings figure reported on the balance sheet at December 31st, 2017. So that's the net income of year one and the balance sheet retained earnings for year two. Assume all amounts are material and ignore income tax effects. Using the following format, enter the appropriate dollar amounts in the appropriate columns. Consider each item independent of the other items. It is not necessary to total the columns in the grid. So the question's really asking us just for net income in this year and retained earnings in this year, but we're going to do net income for both years and retained earnings for both years because I think it becomes a little bit more clear what's happening when we do it that way. Okay, so the first error, we have interest income of $6,800 was not accrued at the end of 2016. It was recorded when we received it in January of 2017. So again, from the last video, we did what the error was versus what they should have done and then compared the two. We're still going to follow that technique here. So the error was that they didn't accrue something. So that means they did nothing in 2016. And then in 2017, when they received the interest income, that's when they recorded it. So they got cash in the mail of $6,800, and they recorded it as interest income. So why is this wrong? The question says that it was not accrued at the end of 2016. So what they're implying is that this interest was earned in 2016, and therefore that interest income should have been on the 2016 income statement. So our interest income should have been in 2016, but we hadn't received the cash yet. So we should have recorded interest receivable, or an asset saying that we're going to get cash in the future. Then in 2017, when we got that cash, we would reverse interest receivable and record the cash. So the question asks us specifically about the effect on the income statement. So we're going to look for income statement accounts. Interest receivable is a balance sheet account, so we're going to ignore that one. Interest income is an income statement account, so we're interested in that. And then cash is a balance sheet account, so we're going to ignore that. So what we have is in 2016, they recorded no interest income when they should have recorded $6,800 of income. So if you don't record income when you should, that means your net income is going to be understated. So if it's understated, we're going to enter it as a negative number, so it shows up in parentheses. And if it's overstated, we're going to enter it as a positive number. So at the end of 2016, when we close out our income statement that has an error of an understatement of $6,800, that's going to flow through and also understate retained earnings by the same amount. Now remember, our income statement is for 1 year. We close out all those accounts every year, and we close them out to retained earnings. Retained earnings is a balance sheet account, and it's going to keep a cumulative tally. All right, so then when we look at 2017, we have interest income when we shouldn't have had any. So now our income for 2017 is overstated because we recognized too much income. So now we're going to take our 2017 income statement. We're going to close out all of those accounts, including interest income, to retained earnings. So our retained earnings account is already understated by $6,800. We're going to add to that an overstatement of $6,800. And so retained earnings will actually be correct at the end of 2017. So this is an example of a counterbalancing error. Our income statement was wrong in opposite directions year over year, which meant that our retained earnings corrected itself after 2 years. Okay, item number 2. Furniture costing $16,000 was expensed when purchased on July 1st, 2016. It is expected to have a 10-year life with no salvage value. The company typically uses straight-line depreciation for all fixed assets. Okay, so for this one, what did they do? They bought some furniture and they expensed it. So we have furniture expense of $16,000 and cash out the door. So then if they expensed it, then after 2016, it was just gone. They didn't have to do anything else with it. But what should they have done? So what they should have done is they should have recorded an asset for $16,000 when they paid the cash. Then they should have recorded depreciation for the estimate of how much of that furniture's life they had used up. So they told us that we should use straight line depreciation, and they bought this asset midway through the year. So we're going to record depreciation expense. And that amount is going to be $16,000 divided by 10 years, and then divided again by 2, because we're only going to take half a year because we bought it halfway through the year. And then that's going to go to accumulated depreciation. Then in 2017, we should take a full year's worth of depreciation expense. We're going to take depreciation expense. Again, that's $16,000 divided by 10 years. And that's going to go to accumulated depreciation. So when we go to look at our income statement effect, we're going to look for income statement accounts. So here we have furniture expense, cash is balance sheet, furniture is balance sheet, and accumulated depreciation is balance sheet. But depreciation expense is income statement. So what they did was they took $16,000 of expense, but they should have taken only $800 of expense. So if they took too much expense, we know our balance sheet is going to be, or our income statement is going to be understated. But it's not going to be understated by the full $16,000 because they should have taken some expense. They should have taken $800. So it's only understated by $15,200. At the end of 2016, we're going to close out our income statement to retained earnings. So the 2016 retained earnings will also be understated by $15,200. Then in 2017, we should have taken depreciation expense, but they took no expense at all. So now our net income is going to be overstated because we did not take an expense which would have decreased net income when we should have. So this is going to start to reverse our understatement in retained earnings. So when we close out our income statement, we're going to close it out to a retained earnings account that is already understated by $15,200. And we're going to add to that an overstatement of $1,600. And so our retained earnings will be a little bit more right. It will only be understated by $13,600 as opposed to the $15,200 it was before. So notice this is starting to correct itself, but it's going a little bit more slowly than the previous example. So this is not counterbalancing because even though it's going to fix itself, it didn't do so in 2 periods using exactly opposite amounts. For the next one, we have research and development costs of $76,000 that were incurred in 2016. they were capitalized and were to be amortized over a 4-year period. Amortization of $19,000 was recorded for 2016, and also $19,000 was recorded for 2017. Okay, so what they did is they recorded a research and development intangible asset. For $76,000. When they paid the cash. And then they amortized it. So they took amortization expense for $19,000, and that would have decreased the value of their asset that they recorded, which was the R&D intangible asset. Then they did this again. They amortized again in the following year. So in 2017, they took 1 more year's worth of amortization expense. So you might remember from when we talked about IFRS, under US GAAP, you're not allowed to you're not allowed to capitalize research and development. So what they should have done is they should have expensed this right off the bat. So it should have been R&D expense for $76,000 when they spent the cash. And then there's nothing to amortize, so we wouldn't do anything after that. So again, examining our expense accounts, we have R&D expense over here. Cash is a balance sheet account, but we have amortization expense. So we wanted them to take $76,000 of expense, and they did take $19,000 of expense. So in this case, our income statement is going to be overstated because they did not take enough expense. They should have taken 76. They only took 19, which means it's overstated by $57,000, the difference between those two amounts. When we close out our income statement, we're going to take that error of an overstatement of $57,000 and move it to retained earnings. So you should be noticing a pattern by now. In the first year of an error, the effect on the income statement and the effect on retained earnings is going to be the same. It's only when we get into subsequent years where we have a cumulative effect in retained earnings and net income is going to be 1 year at a time. Okay, so then in 2017, they took expense when they shouldn't have taken any at all. And so this is going to cause our income to be understated because we're taking expenses that we shouldn't have. And so then when we close out our income statement, we're going to close it out to a retained earnings that's overstated by $57,000. We're going to add to it an understatement of $19,000. And again, we see that our error is starting to correct itself. So here they're amortizing for 4 years. At the end of that 4-year period, our balance sheet will be correct. But again, this isn't counterbalancing because it's not opposite amounts happening in 2 periods. Okay, for the next one, on January 2nd of 2016, Miami Hangars leased a building for 5 years at a monthly rental of $12,000. On that date, the company paid the following amounts, which were expensed when paid. So those amounts are over here. We have a security deposit, a first month's rent, and a last month's rent. So what did they do? They recorded rent expense for the full amount that they paid at the inception of the lease, which was $34,000. Then, presumably, as the year went on, they paid the rest of their rent. Let's say for the rest of the year, that's 11 months. And that monthly rate is $12,000. They paid 11 more months of cash out the door. Then in 2017, we're assuming they continued to pay their rent. Now for a full year. at that same rate of $12,000 for 12 months gives us a total of $144,000 that they paid throughout the year. Okay, so what's the error? Well, the error is that this first amount of rent expense that they paid on the inception of the lease, not all of that was rent expense. So some of it was just that first month's rent. But then that last month's rent, that's going to be prepaid rent because we don't get to use that until the last month of the lease. So that's going to be an asset until we get to the end of this lease. And then our security deposit, assuming that's refundable, which they told us it was, that should be an asset as well because we're going to get that money back. So we'll just call that a refundable deposit. So that is not going to hit our income statement either. And then this is cash at the door. Now, again, we're going to continue on through the rest of the year. We're going to pay our rent for the next 11 months. That part they did right. And next year, we're going to continue to pay our rent, and we're assuming they did that part right as well. Okay, so again, looking at income statement accounts. Here, they got that part right, so we're not so worried about this 11 months of rent expense. That part's right. But if we look at this first entry, they have rent expense of $34,000, and we think they should only have rent expense of $12,000. So that's going to end up being too much expense, which means our net income is going to be understated. So we took too much expense, but not all of that $34,000 is too much. We should have taken the $12,000. So that means we've understated net income by $22,000. Again, when we close out our income statement, we're going to transfer that understatement into retained earnings. All right, then if we look at 2017, we see that the amount of rent expense that they recorded is correct. That's the amount that we think they should have recorded. So we actually have no error in our net income for 2017. So when we close out our income statement, we have a retained earnings that's understated by $22,000. We're going to add to that no change. And so retained earnings is going to continue to be understated by $22,000. And it's going to continue to be understated by $22,000 until we get to the end of this lease and we use our prepaid rent to pay our last month's rent and we get our security deposit back. For item number 5, the company received $28,000 from a customer at the beginning of 2016 for services that are to be performed evenly over a 2-year period beginning in 2016. None of the amount received was reported as unearned revenue at the end of 2016. Okay, so in 2016 we got cash of $28,000 and we reported it as revenue. Why is this an issue? Well, it's an issue because we didn't finish the job. So we got the cash, but we've only performed half of the services. So only half of it can be considered revenue. The other half is going to be recorded as unearned revenue. That unearned revenue becomes earned in the next year when we perform the second half of the service contract. So we're going to undo that unearned revenue. And we're going to record it as revenue. So this one's a little bit different than some of the other ones we did because this one is revenue instead of expense. So again, we're going to look for income statement accounts. We have cash, that's a balance sheet account. We have revenue, that's income statement. We have unearned revenue, that's balance sheet. So we're just going to look at our revenue here. So they recorded revenue of $28,000, but they should have only done $14,000. So if they recorded too much revenue, that means that our income statement is going to be overstated. So they recorded $28,000. They should have only recorded $14,000, which means it's overstated by $14,000, that extra revenue that they shouldn't have taken yet. Close out our income statement. That $14,000 is going to move to retained earnings. Then in the next year, they recorded no revenue when they should have recorded $14,000, that second half of that contract. So now our our income statement is understated. We did not recognize enough net income. We're going to close out our income statement to a retained earnings that is currently overstated by $14,000. We're going to add to that an understatement of $14,000, which means in the end, our retained earnings will be correct. So this is another counterbalancing error. Assuming we don't catch it and fix it, it's going to fix itself in the next period. It had an exact opposite effect in 2016 as it did 2017. For the final one, we're going to do it a little bit differently. We're going to use T accounts instead of journal entries. This one has a tendency to kind of mess with people's heads. So we're going to try to do the best that we can. So here we have merchandise inventory costing $34,600 that was in the warehouse at December 31st, 2016, but was incorrectly omitted from the physical count at that date. The company uses the periodic inventory method. So when they tell us that they use the periodic inventory method, what they mean is that they don't track individual items leaving their warehouse and being sold. Instead, what they do is they track what they have. So they do an inventory periodically. So they do an inventory. Then they track what they add to the inventory. Then they do another inventory, and anything that is missing must have been sold. All right, so we're going to use these T accounts a little oddly. We're going to put in here over and understatements instead of putting in balances like we normally would. So we're coming into this, and our beginning balance of inventory is correct, we're going to assume, because they didn't tell us otherwise. And we're also going to assume that our purchases that we put in there during the year was also correct. But when we did our inventory at the end of the year, we omitted $34,600 of merchandise. So essentially, I had some merchandise that was, in a box under my desk, and I didn't tell anybody, and so nobody counted it during our inventory. So what happens is, if I'm hiding inventory under my desk, and it doesn't get counted, we don't know we have it, we assume it must have been sold, because we're going to plug our cost of goods sold. So that means that cost of goods sold will be overstated by $34,600, or that inventory that we don't know that we still have, and we're assuming we must have sold it. Okay, now here's where it gets a little tricky. Our ending balance from 2016 becomes our beginning balance of 2017. So now our beginning inventory is understated by $34,600. Again, we're going to assume that our purchases are correct. We're also now going to assume that our ending inventory is correct because they didn't tell us that there was any more mistakes in our inventory counts. So now, when we go to do our cost of goods sold, we now didn't know we had this inventory at the beginning of the year. And so if we didn't know we had it and it's now been sold, we don't know that we sold it because we didn't know we had it in the first place. So our cost of goods sold is actually going to now be understated by the goods that we didn't know that we had. Okay. So in our first year, we took too much cost of goods sold because we thought we sold stuff that we didn't. So that's going to be income decreasing. And so our net income is going to be understated by $34,600. Close out the income statement, and that understatement of $34,600 is going to go to retained earnings. In the next year, we're going to understate our cost of goods sold, which means that our net income is going to be too high because we won't take enough expense. We're going to close that out to an account that is already, to a retained earnings that's already understated. And we're going to have another counterbalancing error that corrects itself in the next period. This concludes our lecture on error analysis. Don't forget to email any questions for our discussion.